So, the merge happened. Nothing went wrong. The pandas were released. All the devs hopefully went and got some sleep. And a bunch of uber nerds somewhere probably did the badger dance. Yeah, that almost certainly happened. But that was all last week's news, and as great as it is to be in the post-merge era at long last, and in the sunlit uplands of proof of stake, the chill of reality has set back in, and trust me, it's going to get colder. Well, maybe not that cold. Or yes, maybe that cold. Because I've been saying for a while now that I don't believe we've seen the bottom of this bear cycle, and that's simply because of all the macro awfulness that's weighing on global markets. It probably won't have escaped your gaze either that the world appears to be in a uniquely crappy economic situation right now, and that is likely to be the case for some time to come. After all, memes don't lie, do they? But don't just take a guy on YouTube's word for it, especially when you can also get the opinion of the big bad beasts of Wall Street. And they don't come much bigger or more beastly than Goldman Sachs, Wall Street's vampire squid. Which isn't feeling all that bullish about the near future. Now, like everyone else, the boys and girls at Goldman Sachs are looking ahead to Wednesday's Federal Open Markets Committee meeting, or FOMC, where Jerome Powell and his familiars will decide on the next hike in interest rates. Now remember, just prior to the merge, a disappointing CPI print of 8.3% gave the markets a nasty kick in the cojones, and this hefty inflation figure will be top of mind for Jerome & Co. come Wednesday. Now, Goldman Sachs' blood funnel is twitching because analysts there are predicting that the Fed will hike rates by 75 basis points later this week and then by a further 50 come November. And this will take the Fed funds rate to well over 3%, a figure that seemed fanciful just a few months ago. Remember that we've had record low interest rates for years now, and these hikes are the principal reason why the crypto market has been tanking in recent months. And for a bit of context, the last time Goldman Sachs gave its opinion on these rate hikes, it predicted 50 bips in September and a mere 25 in November. Now, the higher interest rates climb, the less attractive risky assets like stocks and especially crypto will be to investors. The likelihood of further sell-offs is why many are now predicting that BTC could fall as low as 12K in the coming months, which sure as heck makes our current struggles around 18K look almost joyful by comparison. Now, there is a good chance that the market has already priced this 75 bip rate hike in, which would mean that a drop to 12K is less likely, at least in the next few weeks. However, consider the fact that, according to the FedWatch tool, there is currently a 20% chance that we could see a rate hike of a full 1%. Now that would be the biggest single rate hike in 40 years, and trust me, that would go down about as well as a Gary Gensler cabaret performance at Bitcoin 2023. Come on, babe, why don't we play? So, as you try vainly to get that picture out of your head, consider too the fact that a lot of institutional short positions have been opened for BTC according to data from the CFTC. While for those who prefer to trust to technical analysis, there ain't much comfort there either, I'm afraid. In short then, whether you're in stocks, crypto, or indeed pretty much anything else, this winter is going to suck. Soaring interest rates, stubbornly high inflation, a continuing war in Ukraine, further global unrest, energy bills so high we'll all have to do the badger dance to stay warm, and all the other crappy things going on right now. So make sure you've got a nice big duvet and get ready to spend a considerable amount of time under it.